Welcome to our premier event. Thank you all for tuning in. If 2020 has taught us anything, it's to be flexible. As we innovate and redesign our traditional sense of meetings, we are thankful for digital platforms that allow us to expand our reach. Before we introduce the main event, I wanted to take this opportunity to highlight a few items for the upcoming year. While transitioning to digital programming has had its challenges, it has allowed us to provide access to more frequent content, partner with other societies, and grant access to content at your convenience. Facebook, Twitter, and LinkedIn have proven to be great avenues for sharing our content. Be sure to like, share, and follow our pages to stay up to date on current networking opportunities. Last but not least, we're excited to announce our new Meet a CFA webinar series. If you or someone you know is interested in obtaining your charter, this is a great opportunity for you to connect with other CFA charter holders to learn helpful hints on passing the CFA exam, as well as connect and network to help further your career.
Thanks, Chuck. My name is Justin Pinckney, and I'm your newest VP. That's Virtual Professional or Vice President for CFA South Carolina. After today's presentation, we'll have time for Q&A, so please use the chat function in Zoom to submit your questions to Bob. If you haven't done so already, please use slido.com or scan the QR code with your camera app right now to participate in our polls. We're pleased to welcome Bob Dole of Nuveen, Senior Portfolio Manager and Chief Equity Strategist. At Nuveen, he manages 7 portfolios, which include large cap equities and alternatives portfolios. He's a highly respected authority on the equities markets and author of widely followed weekly market commentaries and annual market predictions. Prior to joining Nuveen, Bob held senior roles with BlackRock, Merrill Lynch, and Oppenheimer. He holds degrees in accounting and economics from Lehigh, an MBA from the Wharton School at the University of Pennsylvania. He's a CPA, and most importantly, a fellow CFA charter holder. Bob, the floor, or should I say the screen, is all yours.
Thanks so very much. Hi, everybody. Hi, fellow CFAs. Yes, these are unusual times. I sure wish I could be there in person, but I guess I'd be part of an empty room. So let me take you through the slides. I had to submit them a couple of months ago, so some of them are a little outdated, but we'll make our way through. There are a couple of polling questions along the way. And most importantly, I hope I can answer a few questions for you at the end. So let's proceed with the next slide, and we can get this going. What you see on this slide is really the intro slide that tells the story. Never before in history has consensus expectation regarding global GDP made as big a change as you see on this slide. In early March, the consensus said global GDP this year would be plus 3% real. 6 weeks later, minus 3%. We've never had that kind of change to repeat ever, let alone in 6 weeks. And so the Howard Marks quote, these days, everyone has the same data regarding the present and the same ignorance regarding the future. Well, we know a bit more about coronavirus, and we have a few more data points about the economy and the markets. There's still no playbook to go to. And therefore, a lot of what I'm going to say is conjecture. Predicting the future is always uncertain, but it's extra uncertain. So let's move forward. Okay, this is a little bit of history. This went through June 30. It's just a picture of the U.S. stock market. To refresh your memories, all-time high February 19, followed by the swiftest bear market plunge in history, down 35% in literally about 35 days, 23 trading sessions. And then we bounced that same 35%. Of course, when you start at a lower level, it doesn't go as far to get the 35% in literally the same number of days. And not pictured here, but as you know, we spent post June 30, the first half of the third quarter kind of going nowhere. And then we started a climb again, which took us to 3,600 as of early this month. And we had a quick pullback, double digits for the NASDAQ. And now we've been pushing our way higher again. My view is the path of least resistance continues to be higher, but the rally is a bit more high risk than where we were before. And I'll try to put some meat on the bones for that going forward. Next slide. So I spend most of my time managing money, not talking about markets. I manage large cap US strategies, plain vanilla large cap core designed to beat the S&P 500 and a few other long only strategies. But I also have two long short strategies, one an equity market neutral and one equity long short target beta 0.7. In order to manage money, you've got to have a compass. And these are the 5 points I'm using these days to give me a feel for where we are, where we're going, and how I have to think. So let me take you through them. Number one, the economic recession is over. When I said that a couple of months ago, I got a lot of pushback. But as you all know, the recession lasted 3 months. A recession ends when a recovery starts. We are still in recovery mode. We don't get to expansion till we get to new all-time high GDP, which is likely, I'm going to call it 15 months away. I also believe that the V-shaped recovery that started will become more wavy. That is to say, when you turn the economy on after turning it off, some things come back with a vengeance. My guess is most of that has come back, and now we've got harder road. We're going up and to the right, don't get me wrong, but I don't think it's going to be a straight line. Number two, thank goodness we've got the most significant and quickest blast of government stimulus and aid in history. And that avoided a longer recession and has certainly aided the economy. Number three, not talked about a whole lot in recent days, but a couple of months ago, this was high on people's lists. Are we going to have a secondary coronavirus wave? My guess is we'll get some secondary coronavirus, but the lockdowns are over. I'll have more to say about that in a minute. Number four, a return to pre-COVID economy and earnings, 18 to 24 months. Pre-COVID economic levels, as I said, probably early 22. Pre-COVID earnings levels, probably late 21. And finally, number five, after a swift bear market and significant recovery, my guess is we are now in a more of a churning phase for the stock market. As I said, about 3,400 as we speak. The high was 3,600. Let's say we have a 3,200-ish floor. We may bounce around within that zone for some time. Some days I feel like 3,600 was the high for the year, and we're just going to churn for the next few months. We'll see. Next slide. So I want to cover briefly 7 subjects. The first 6, very briefly. The 7th, I'll spend a few more minutes. So we go to the next slide. Let me talk about policy. I've already hinted at this, and you know it, but let me just underscore. Monetary policy. I think the Fed deserves high marks for its efforts. They were there early, they were there big, and they were there continuously. The Fed has basically said, we will backstop what is necessary. The first thing, of course, they had to do was calm the markets. And then immediately after that, narrow spreads, which is a further calming. And now, of course, they've got interest rates essentially zero, and they're telling us that's where they're going to be for as far as the eye can see. The Fed is at the ready should there be any issues. And of course, it is among the reasons why the stock market has done well. The Fed largesse. That's not new news to you, but it is important positive that continues. It is a tailwind. We all know Marty Zweig, another CFA back in the day. Don't fight the Fed. On the fiscal side, maybe not the A that the Federal Reserve gets, but B plus. They were there pretty quickly. Reasonably targeted programs. Not all the money's been spent, as you know. And of course, in the headlines are we going to get this next bill? I put here when I made these slides in early July, likely pass before the end of the summer. That's obviously changed. We may not get a bill. The consternation, the fighting, not only across the aisle, but also within parties, aided by the fact that the recovery has been better than people thought. And as a result, there are a lot of people who are saying, do we really need another package? My guess is if we don't get another stimulus package, we'll have a weaker fourth quarter than if we do get another package. But the jury's out on that. Lots of money to repeat, still in the system from the fiscal stimulus unspent. Next slide. Number two, the economy. So as you all know, we've largely seen a V-shaped recovery. I just saw a couple of hours ago an up-to-date industrial production graph for the US economy for the year 2020. And of course, after the big decline, we saw the V rise, and the pace is still, the direction is still up, but the pace has slowed noticeably. I think we're going to see that in a lot of statistics. Still up, but at less of a rate. I highlighted a few things. Some of these are a little outdated, but they make the point. May was the first payroll that was off the charts. Millions of jobs better than expected. Retail sales that month, up 17%, by far the highest in history. At this juncture, auto production estimates, after being down 57% in the second quarter, projected to be up 145% for the third. That number now is over 190%. Of course, there's been some replenishment in inventory in that number, but the demand for old and for new and used cars is up significantly. One of the statistics I quoted lots of places, number 4 on this list, is the car moving company Lyft said its results in May were up 26% for April, but still set down 70% year over year. You see the dichotomy and the confusion among ordinary people that don't look at this stuff every day. Back to jobs, we lost, as you know, about 26 million jobs. We've gotten so far about 10 million back, so let's call it a little more than a third. I think between here and the end of the year, we'll get another 6 to 8 million back, and then I think it gets harder from there. Next slide. So earnings. In April, after this thing hit, we immediately took our expectations for 2020 down to $125 and 2021 to $150. By the time we printed this in early June, we had a 150 to 160 range for 21. I am using currently $130, which, by the way, is exactly where the consensus is, 130 for 2020, and we're using 160 for 2021. The consensus is $166. So big hit, big improvement. Inside the quarters, you probably know the fact that the third quarter that we'll start reporting soon will be up from the second quarter, call it 15 to 20%. It'll be obviously the first up quarter, but all 4 quarters of this year will be down from a year ago if we put the fine tuning in. Next slide. All right, coronavirus itself. This slide is hopelessly outdated. It was made at the end of June when, of course, the coronavirus cases were moving up in certain parts of the country, especially the South. That number has now come down and it's below the recent low we saw there in May. And let me say it qualitatively. New cases, hospitalizations, and deaths from coronavirus continue to fall in the United States at a pretty good pace. There's some flare-ups in other parts of the world, but in the US, things are pretty well behaved. And I remind everybody that the shutdown was, the lockdown was put in place not to correct coronavirus, but to avoid overtaxing the healthcare system and allow time for therapeutics and other ways to treat the coronavirus. Since that's now in place, we are learning to live with coronavirus. In my view, there will be no more shutdowns. Next slide. Again, I think you probably by now know some of what you see on this slide, but let me put it this way. We know a ton more about coronavirus today than we did in March. In February, I didn't know how to spell the bloody thing, and now we know a whole bunch more about it. It is amazing to me that 80% of the deaths over the age of 65. I saw statistics just yesterday said approximately 99% of the deaths occurred in people that had other health issues, comorbidity issues. So coronavirus by itself has been much less deadly than people feared. Next slide. So there are a lot of things that have changed. Let me just highlight two important ones from my point of view that certainly affect markets. China. China, arguably in most respects, the second most powerful country in the world behind the United States. Through 2019, with all the trade negotiations, the US and the West in general viewed China as a competitor. Sadly, that is no longer the case. China is now viewed as an adversary. Yes, coronavirus, but some other things along the way have shifted that relationship. And when the number one and number two powers in the world are in a Cold War, make no mistake, we are in a Cold War with China. That's just not great news. So keep your eye on that space. Let's hope that war remains cold and never becomes hot. The other big change in our view is the likely presidential winner. This has nothing to do with the polls. It's just some analysis. Coming into the new year, we thought President Trump would be reelected perhaps in a cakewalk, but now we believe it's more likely that Joe Biden will be elected president, and the next slide gives you the reasons why. As you may know, 16 first-term presidents have run for a second term since the year 1900. The 10 that ran without a recession were all reelected, and that's where President Trump was on January 1st. Then a recession hits us across the face, and you can see not so much when you run for a second term and you have to face a recession, you're mostly turned out of office. Somebody said he didn't cause this, nothing to do with it. Well, when a football team loses the game, the coach gets a lot of the blame, whether it's his fault or not. That is the reality. And then when this slide was made, it is almost the same case now. The 6 borderline states or battleground states that are likely to decide the election were all in the highest quartile of unemployment claims. So those realities make it difficult for a re-election. It's a long time. It's over almost 50 days until election day. I guess it's exactly 7 weeks from today. We'll see. So how will the market react? Well, in our view, the market's preferred scenario would be a status quo election. President Trump reelected, Democratic House, Republican Senate. Close behind it, in my view, is that the market could live with a Joe Biden presidency as long as the Senate remains Republican. Should it be a Democratic sweep, which has a much higher probability than it did 3 months ago, at least according to the money and opinion polls, that would create, I think, some concerns on the market. One, because we will get higher taxes on corporate America and high income and high wealth Americans. And number two, some re-regulation, neither of which are great for markets. So we'll see how this one transpires. Next slide. I think the question I get asked most often these days, aside from where's the stock market going, is who's going to pay for all this? There's no question we are borrowing from the future. There is no free lunch. I show you here federal debt as a percentage of GDP, and you all know that within a couple of months, it's going to cross 100%, and within a couple of years, we'll hit a new all-time high, surpassing the prior record we set post-World War II. Next slide gives some of how we might deal with this. We have borrowed from the future, as I already said. When I get this question, I said, great question, but can you save it for next year? The powers that be are worrying about getting us out of the mess, not how we're going to pay for it in 2020. Beyond this, I think there are at least 3 ways to deal with it. To be a textbook professor for a moment, number one, like Japan, we could decide to kind of keep the status quo, let the deficits and the debt remain high. We see where that's gotten Japan, much slower economic growth, not very pleasant. 2, we could do what we did post the Great Recession, significant increase in taxes. That's not very pleasant either. And the third, not very pleasant alternative is to monetize the bloody thing, which would lead to some inflation and a lower dollar. My guess is in the years to come, all three of these will have their day in the sun. And sadly, the decision is more likely to be based on politics rather than economics. Next slide. So with that in view, let's move to the stock market, where I've got a half dozen or so slides, a few concluding slides, and then we'll see if there are any questions. So what are the risks? There are many. I've summarized or highlighted just three of them. One, I already alluded to this, valuation. So if $160 is the right number, 20 times 160 is 3,200, which is 200 S&P points below where we are. Now, some bull out there is saying, Bob, if interest rates are zero, shouldn't PEs be infinity? And in some sense, that's right. But I can't look you in the eye and say, you know, you got to buy stocks today at 23, almost 24 times earnings because they're going to 26 or 28 times earnings. They might be, but I can't argue that. So I think valuation is a bit of a risk. Number two, politics. I already talked about the election to some degree, but that's not the only political issue. The geopolitical issues, Brexit's back in the news, the tensions with China. And thirdly, again, already mentioned it, and no one can really handicap this, but what's the risk of a second wave of coronavirus, and how will we deal with it, and how will the economy and the markets react? Next slide. This is, for some reason, it looks like the timeline didn't show up here, but I think this is, it says at the bottom. This is almost the last 15 years, the PE on forward earnings, and you can remember and see that it dropped to below 13 times just 6 months ago at the bottom of the bear market, and has nearly doubled to be well into the 20s. Valuations have spiked, both because the market's gone up and during that period, earnings estimates have come down. Next slide. So this is a busy slide. All it argues is when you get strong periods, what usually follows is another strong period. Shown on this slide are the strongest 10 3-month periods since 1960. And then at the bottom, you can see the 3 months ended June 24th was up 36%, making it the third strongest 90-day gain in our recent history back to 1960. What happens next? Well, that's what's summarized in the three columns to the right. 3, 6, and 12 months later, the stock market is higher 90% of the time historically. And of course, the rate of gain is time and a half to double what it normally is. So there's a tailwind that comes with strong returns. Let's call it momentum. Next slide. Cash on the sidelines, and it's gone up even since this June 10 reading, as you probably know. This is assets held in money market funds, but you can measure cash lots of different ways. Cash held by mutual fund managers, way up there. There's a ton of cash, and last I checked, it's earning around zero. So this is fuel for the fire, if you will, if you want the FOMO and TINA, fear of missing out, and there is no alternative argument as one of the bullish reasons for the market going up. Next slide, please. I think, and most of you know this, especially if you have anything to do with small stocks, in the Russell 2000, approximately 40% of the companies failed to earn a profit in the 12 months ended June 30. Pretty amazing. We have that many companies not earning any money out there. You can see it's always a significant number, but it has these moves up. And of course, among the reasons active managers have struggled is the number of zombie companies that are out there. If interest rates weren't zero, essentially, some of these companies wouldn't be in business anymore. And so this is a challenge for all of us, and I thought a relevant point to put up there. Yes, next slide, please. So any of you who are U.S. portfolio managers like I am, you spend a lot of time on these kinds of issues on this slide. I show you 5 comparisons. Again, sadly, this only goes through June 30. In the left hand of each pair are, at least until recently, the no-nos. And the ones to the right are what you could be proud about. If you could talk about your portfolio Most times in the last few years, as big cap growth stocks that were defensive with low beta and in the US, you know, you look like a genius. Conversely, you were embarrassed, ashamed to admit if you own cyclical value, small, high beta international stocks. My point, and some of these graphs have begun to shift, is to say it's no longer an either or. I think it's a both and. Of the pairs, the one I feel strongest about is I think you need to own fewer defensive stocks and more cyclicals. It has some correlation, but not perfect to value and growth. I think there are good growth stocks and there are good value stocks and bad in each column as well. So of the 5 pair, that's the one I would take. Not relevant for me as a portfolio manager, but I also believe with the decline in the dollar, the absence of interest rate premium, probably the absence of a significant economic premium, and the fact that the US is the most defensive market in the world, fewer cyclicals than most other big markets, that international stocks have and will continue to do a bit better than the US. Next slide, please. The dollar, and you can fill in the slide since June 30. You know what's happened. It's moved down in that long zone it existed for months and now pierced the lower side. Coronavirus hit, and of course the safe haven status of the dollar caused it to move higher. And then as we digested that and began the recovery period, the V recovery, the dollar began to weaken, of course, has weakened further. Given what I've just said about international and interest rates and relative economic growth rates, while the dollar is oversold, in my view, short term, I don't think we've seen the low in this phase over the next bunch of months and perhaps several years. Next slide, please. Well, as you also know, one of the big issues is, you know, how high is high for, you know, the favorite 5, the magnificent 5, however you want to call it. The label is obscuring it. I think I have the slides here, if I can read it. Yeah, we were in the low 20s, 22% on June 30. These 5 as a percentage of the market. In the 1st of September, this got up to 27%, and as we speak, between 24 and 25. There is no predictability from something like this. People have tried. There is no predictability. You know, I can be a bull and argue that Apple, Microsoft, Alphabet, Amazon, and Facebook have had phenomenal earnings and in most cases cash flow growth, and therefore they deserve to have outperformed. Yes, I can be a bear and say, you know, how high do trees grow? Do they really grow to the sky? As a portfolio manager, I still own some of all 5 of these companies. I own less than I did. I've been a trimmer over the last, probably 3 months now. But on significant weakness would add back. These are fine companies. I don't think the bloom is off the rose. It's just they've gotten pretty expensive versus the rest of the market. And it comes back to most of these are defensive stocks, and they fit that, you know, growth, defensive, mega cap category we mentioned before. If I'm arguing it's no longer either or, but both and, I want to have fewer of them today than I did a couple of months ago. Next slide, please. So let me begin to pull this together. Positives and negatives, a balance sheet or a laundry list. Positives, the sea of liquidity provided by the Fed. I was kidding with somebody recently saying, you need some money? Call the Fed. They seem to have an unlimited supply. Number 2, economic improvement. We are way off the bottom. This economy has advanced faster than almost anyone who is honest with you would admit. 3, the momentum in the market. Momentum begets momentum. You know that. 4, broadening participation. That can also be a negative, but we got new folks in the market. I'd say Robinhood was as emblematic of that. And number 5, I mentioned this already, fear of missing out, and there is no alternative. These are among the reasons the stock market's path of least resistance is higher. But on the other hand, I also mentioned higher risk. Second quarter economic and earnings are in the history books now. So let me say it this way: the move from V to more wavy, valuation, coronavirus concerns. I just said the unevenness of the recovery and the political risks that we already covered. There are more positives and negatives, but I think these are the key ones. Next slide, please. Behavioral changes. So look, I'm no expert, I'm no sociologist, but I've lived long enough to know that when things change, a lot of them revert back to where they were. And my case in point is 9/11. I remember the papers and articles and books that were written to say the world's changed. Most things didn't change. Within a couple of years, they reverted back to what's normal. Now, I'm not making the case that everything's going back to normal. Let me start with the secular changes that were in place prior to coronavirus, accelerated during coronavirus, and aren't going away. Deglobalization, digitalization, online shopping, and there are probably a few others. To the left of that line, I think there's more of the jury is out on these. Look, most of us are working from home now. A year from now, more of us will be in the office than today, but not as many as were the case a year ago. So most of the other things on this page are going to go back to some semblance of normal, but at a slower pace, and maybe not get back to normal, but the trend's going to reverse from what we've seen in coronavirus, in my view. Next slide. So let me conclude with these 10 conclusions. I'll read them and comment on a couple of them, and then we can open this up for questions. Number one, COVID-19 cases and fatalities are not over, but the numbers are falling, thankfully. Secondary recurrences remain a risk. Number two, we have witnessed absolutely horrific second quarter economic earnings data. That's history. Three, reminder, this is a painful exogenous shock. It is not a systemic structural break like 08 or, God forbid, 1929. My silly illustration is picture a guy walking down the road and he gets hit over the head, didn't see it coming, by a 2x4. Knocks him over, knocks him out, does a little damage, but he gets back up on his feet, turns around, can't find the 2x4, it's gone. That's an exogenous shock. A systemic structural break is that same guy's walking down the road and has a coronary. That could be terminal, it could be damaging, it could take some time to repair. They're very different from one another. Number four, the key to a better economy and market hinges first and foremost on the coronavirus data. I think we established that. Five, the recession is over, but boy, are we thankful for the blast of aid and stimulus. Six, the bear market ended March 23rd, but stocks are in for a churn. Seven, a year from now, I believe stock prices and interest rates will likely be higher than they are today. Let me make a comment on interest rates. If you took me off the planet on March 23rd and said, Bob, I'm going to send you back to the planet, but you need to know what's happened with the economy, and I was told all about that. I was told all about what the Fed was doing. I was told all about where the stock market did, earnings and all that, but I wasn't told what happened to interest rates out the curve, and I was asked to guess. My guess would not be, where are we as we speak? 68 basis points in the 10-year Treasury. It'd be more like 98 basis points. I think that's a bit anomalous. I think it will correct, but I know a lot of people have been calling for higher interest rates for not a few weeks or a few months or a few quarters, maybe decades. Time will tell. Number eight, because no one can pick tops and bottoms, if we get the volatility around this churning, dollar cost average is a great way to get in out of things. I didn't talk much about sectors, but tech and healthcare have outperformed in QE periods. This is QE4 and QE1, 2, and 3. Those sectors outperformed all three times, and UTs and REITs have lagged all three times. And guess what? That's happened again. Finally, number five, the 5 data points. I'm in a long list. I'm sure you all have yours that I'm watching: coronavirus data, credit spreads, the yield curve, copper prices, and weekly jobless claims. Now, I know we were supposed to have a few polling questions. They kind of popped up and disappeared. I don't know if the mechanism exists, if we want to do them now. If not, we'll open this up for questions.
Thanks to technology issues, we are having some problems with Slido. There is a poll that's up right now that is asking everyone, where do you think the S&P 500 will trade 1 year from now? We can let people vote. Of course, you go to slido.com, slido.com, and type in M180. And as those populate, Bob, we'll go ahead and let you know the results that we're seeing. The
Excellent.
options are under 3,000, 3,001 to about 3,400, and then 3,800 plus. In the meantime, we do have a question coming in through the chat that we can go ahead and talk about. With recent Fed policy and equity performance, do you expect a long-term shift to higher equity allocations and asset allocation models for retail investors?
Well, more equities is certainly not what they've been doing during this, even before this, but let's just talk about the market advance off the March 23rd lows. Seems like just about every week we've had inflows to bonds and outflows to equities, and the equity market has gone up most of those weeks. So that's not what they're doing, although, of course, if you just sit with your portfolio and do nothing from March 23rd, your equity percentage has gone up. My view is that it's still probably the right thing to do. I'm not sure I chase things now, but I'm a big believer in dollar cost averaging. My view over the next 3 to 5 years, stocks, bonds, and cash are all going to have below normal returns, but stocks will probably win the race, and cash will give bonds a big run for the money, even though neither of them will do very well. Or let me say it differently, if your actuarial assumptions or your projected asset mix returns give you, 6-7% total return from a traditional stock, bond, cash portfolio, good luck. I don't think those asset classes are going to do it for you unless you're a really, really good stock and bond picker.
Perfect. Another question. Do you think we'll see a meaningful change in inflation come through in the aggregate CPI data? If so, when?
Yeah, so we've obviously in the last, I think it's 4 months now, witnessed CPI, consumer price deflator. We've seen them stabilize or move up from those very low deflationary levels. I am of the view that inflation is going to pick up some. I don't think we're going to have anything like the problems some of us grew up with, but I think the era of, I'll call it zero inflation or deflationary threat is probably in the rearview mirror. Thank you, stimulus from every place under the sun. If you look at money supply in virtually every country in the world, it's up the limit. So my view is we will see some pickup in inflation, enough where the Fed's not going to be able to leave Fed funds rate at zero kind of forever. 3-4 years. I think a year from now we'll all be talking about, gee, I wonder when the Fed's going to come off that zero notion. So I guess you hear me saying, yeah, a little more inflation, but not a disaster. Certainly not an inflation rate consistent with zero Fed funds and a 68 basis point 10-year treasury.
Looks like we have another question. You mentioned you're trimming positions in big tech stocks. Where are you recycling these proceeds?
Yeah, I'm recycling them to some consumer discretionary names. I have bought some of the economy reopening names. I think that short-term trade is getting a little long. I'm looking at the financials, thankfully significantly underweight, but boy, their valuations are becoming intriguing. I guess I'm still from Missouri. I need to see yield curve steepening or something to tell me these companies are going to earn some money. In the meantime, they are pretty cheap. So that's where I've gone.
Perfect. Looks like we have a busy chat feature today. What can come out of the FMOC Wednesday that would be a change to the prior position?
Yeah, my view is nothing. I think they're very well scripted. They will talk some more about their noticeable shift to a more balanced view of inflation, which is, I should have mentioned in my answer to the inflation question. The Fed is clearly not going to stop inflation at 2%. They wanted to average 2%, not have a peak of 2%. So I think they will further amplify on that. I think they will talk about the decent news we've seen in the economy. I think they will also talk about, for example, the industrial production number to say, yeah, it's going up, but the pace of gain has slowed a little bit. My guess is they will chastise Congress for not coming up with another stimulus package and try to motivate them to do so. So they're the things I'm expecting.
Perfect. What is something that you read every day before you start your day in the market? With the with the reason for the question due to keeping track of the pandemic in relation to changes in the market.
Yes. So the truth is, off the top of my head, I read the Bible before I read anything else, but that's for another day. What I typically do is have sources from all over the place where I read emails. Some of it is from brokerage firms, which describe what's happened overnight. You mentioned in the question the coronavirus detail. Tom Lee of Fundstrat has done an amazing job with a couple of his people that have given all of us more information than we need on coronavirus. So I hope that's helpful.
Perfect. Do you or Nuveen see crypto as a legitimate asset class? And if so, do you have efforts underway to allocate this to the market?
Yeah, so we're watching it carefully. We're analyzing it. We haven't done anything. Sort of like I said about some other subject, call us from Missouri. So in my view, there is technology, there is efficacy to cryptocurrency. I just think we don't know enough yet for it to become, I'll call it a legitimate investment. So I guess, therefore, I have to still call it a bit of a speculation. Some will quarrel with me on that. So I think we need to see it get a little more depth, a little more testing before we're willing to say, and we have to get our arms around to be able to have a significant opinion where we think we can add some value as opposed to just use it as a spec.
And what are your thoughts on Russell 2000 at these levels?
Yeah, it's there have been many days, back to my toing and froing, and it's no longer either or, but it's both and. There's some days where the Russell 2 has done just amazing performance, and then we get a day like today where the market's bouncing. I see the Russell 1 is up 101 basis points, and the Russell 2 is up 51 basis points. So small's lagging. I will say in my portfolios, I'm slowly bringing the weighted median market cap down. So I guess that's a view that back to it's no longer either or, it's both and. Look, in later stages of economic cycles and later stages of bull markets, you eventually get that catch up from the next rung. Anybody who is at all value conscious, you know that price to earnings, price to cash flow, the Russell 2 is pretty attractive relative to the S&P or the Russell 1. So I think there's a place for it where permitted in portfolios.
Perfect. This is a two-part question. What is your favorite industry group to own for the next 10 years? And we also are getting a couple of comments on your views on gold and the message being sent by $2,000.
Yeah, so unlike my answer on gold a couple of years ago, I'm more constructive. It ties into the reflationary bridge that the policymakers have built for us. It ties into the Fed's change in the way they're going to view inflation. It ties into the massive increase in money. And I know that needs to have an increase in velocity for it to make its way to GDP and all that good stuff. But I put all of that together, and I want to own tips over treasuries, and I want to have some gold in my portfolio. 10-year time horizon. I'm going to sound like a boring old record. It's technology. We are going to have technology as a higher percentage of GDP 10 years from now than we do today, period, full stop. And you can pick your spot. I know the software stocks have done so well, but they're doing new things. The cloud, it's related to software, but also other parts of technology. And I guess I would put another leader, healthcare, in the second spot. We are going to have an older population 10 years from now than we are today. And when populations age, by definition, they spend a higher percentage of their income on healthcare. So I gave you two for the price of one.
Perfect. Is value investing dead, or has it been negatively influenced by low interest rates for the past decade?
So I'm going to answer yes to the second part, no to the first part. So maybe a necessary condition for value to do well is a more normal interest rate structure, and who knows when that's going to come. Growth, growth obviously by any measure has outperformed value almost no matter how you define growth and value. I tend to use the Russell definitions because people pay attention to that. They're not going to pay attention to anything that I have to say. I don't think value investing is dead. I think you have to recast how you approach value, recognizing that the world has changed in a financial repression environment in which we find ourselves. I don't want to say this time's different, but we have to be cognizant of changes in the structure and kind of redefine what it is that we do and how we do it. Or I say it differently, every growth rate has its price, and therefore, if a stock is cheap relative to a massive growth rate, it could still have a high P, and you could call it value. So I'm not saying get away from your bailiwick or cheat in any way, shape, or form, but I think that value is not dead.
Wonderful. It looks like we have time for two more questions. With the first one, within this pandemic, we have had companies without solid cash flows reaching record high levels, such as Tesla. What are your thoughts regarding auto retail and forecasting Elon Musk's technological visions? Lastly, a new competitor went public, Nikola, but also without reasonable cash flows. Is it reliable to have a positive forecast on them?
So I'll be honest, I make a lot of mistakes in this business. I mentioned long short portfolios, and I was short Tesla for quite some time. We were lucky enough at some point to cover it, but boy, did we lose a lot of money. I don't understand it. I have some bullish friends who have tried to convince me it's the best thing since sliced bread, and I say it better be at this price. So I think it's part of, and the new public offering, Nikola, and a raft of other stocks that trade at valuation levels that most of us have been around for a while, just can't get our arms around. And yet they tend to go higher. I think Tesla is a wild story that we've not seen all the last chapters from yet, positive and negative. It'll be fun to watch. So this guy's gotten it wrong.
Perfect. Last question for the day. Your estimate of a 0.3 rise in long-term interest rates doesn't seem like a large move. Will interest rates be permanently lower?
So my just picking a 0.98 out of the air, 0.3 higher than where we are today is today. I mean, I think that's where rates, if I had no knowledge, and some days I feel like I don't, about where rates are and knew everything else, I think that's consistent. I do think rates will go higher. I think that before this cycle's over, rates will be noticeably higher than where they are, but they're not, in my view, going to 6 or 7%, which was low compared to some times in my past. But could we see a 2 handle on a 10-year? Absolutely. If you buy a 10-year treasury today and, X quarters from now, it's yielding 2 point something or other, you're losing a lot of money. So I think rates will go higher, but we've got to get out of, and that probably significantly, noticeably higher rates will not come until there's some reversion to normal for the economy, and that won't happen likely until we have a vaccine where people are willing to, come out from under their caves and do life as normal.
Perfect, Bob. Just to go back to the active poll we have, where do you think the S&P 500 will trade 1 year from now? It looks like the majority of people said between 3,400 and 3,800. Do you agree with that answer?
I do. I think stocks will be higher a year from now than they are today. We're at 3,414, so that's comfortably in that range. 3,800 to be nice. That's another, nice double-digit gain from here. I'm not sure we're going to get that unless earnings are a lot better than $160 in 2021, and or we have visibility for another big gain in 22, which I think is less than 50% probability.
Well, on behalf of CFA Society South Carolina, we truly appreciate your time. Thank you for Nuveen being a sponsor, and we hope to touch base later in the year.
My privilege. Good luck, everybody.
Thank you.